interested in the higher time frames. They are too slow, boring, and they much prefer to trade lower time frames. The main reason for this is because on the lower time frames, the markets are moving like crazy, and this is the new trade signals, many trading opportunities. The biggest thing that same traders are facing to notice is that while they are pretty of the opportunities on these very small time frames, there are also many more facing signals with the wipe them out. The smaller time frames can provide to the by the very effective, but they are also notorious for the eating up traders accounts because of the place they move and just how erratic the moves can be. This can make especially hard for the nervous traders trying to learn how to trade just effectively. The best things to do if you are trying to learn how to become profitable in the trader signals on the daily chart. This will allow you to have the time requires to make informed decisions. Many traders will find this hard, but they might also continue to struggle to make money until they make the change. Of course, you don't have to always stick to the daily charts, but if you are losing many traders, I highly suggest giving the higher time frames a go. Once you have become the profitable using the higher time frames, you can then consider moving to the charts. The transactions on the daily charts is the heart, and the majority traders are recurrent to make the switch because of the some missed connections or the myths. So let me evidence some of the corners on the micro-options you may have about the trading on the daily chart. The first microceptions I heard at the time is that the higher time frames are not as profitable as the lower ones. The majority of traders, especially the newbies, are so focused on the short term charts because they are because they have earned the market with the wrong mindset. Many traders believe if you put the hours starting on the chart, you will get the result like in real life. If you put the extra overtime at your job, you will generally be rewarded for your extra efforts. The financial market don't work this way. In fact, it's the opposite. You heard on expressions work smart, not hard, right? Well, trading the daily time frame is exactly that. When you're trading in the environment like the 1 minute or 5 minute charts, your ranking of the trading market's noise. Rented the longer time frames won't throw the trade setup such as high place, but the signals that are generated on the daily time frames are much more reliable and have much better chance to work out. It's the whole quality as the quantity argument, and quantity is more important in trading and investments. It's better to trade handful and high quality trades rather than trying to trade lots of the poor quality ones. Daily time frames offers more clarity by providing the bigger picture. It's easier to identify the core price movements and get much better read into the market. Physiologically, on the daily chart, you will be able to read the market much more easy than reading the lower time frames chart. At the same time, signals on the daily time frame contains more valuable as the good trading opportunities because they contains more price data within the signals. Also, signals on the daily time frame are allowing for the better chance on the hit of the higher rank rewards on your trade. The second miscount is that the daily time frames is too expensive to trade if you have a small account. This is wrong. Your account size doesn't determine to what time frame you should be trading. All these speculations flows from the idea that the wider your stop loss, the more experience the risks. It's true that your stop loss will be wide when you work with the trade signals determined from the daily time frame, but the move you will capture are just as large. Traders who believe the daily time frame is too expensive to trade simply don't understand how to calculate possible size correctly. It's possible to risk $100 into the 10 pip wide stops or 100 pip wide stops. They just numbers. You just need to be able to work with them properly. It doesn't matter if you have $100 or $1,000 or $10,000 account. If you understand positions sizing, then you can trade on the higher time frames and with ease. Another misconception is that the longer you are in a position, the higher the risks. So there's the many traders that will push the idea that being in and out for the markets is less risky and holding positions on the longer term. The reality is you are always going to be at risk of the being stopped out from the unexpected market, even no matter what time frame you see. In fact, you are more likely to be stopped out by the intraday volatility when you take the lower time frames setups and use small stop losses. The daily charts does a good job of the filtering out the intraday notices, providing you with the more reliable data to basis your trading decisions. Most daily time frames setups are hardly unaffected by the intraday volatility that affect the short-term traders. Lower time frames are exciting, yes, but they also requires to be at the computer and monitor price movements for many hours. Most short term traders intuitively love the thrill and the actions. The fact the the fast paced chart provide, but it's only the matter of the time before your experience meta burned. Once your meta disqualified runs out, greed, for instance, anger and impotence will start to trigger bad orders, sending you into the danger. Trigger bad trade, sending you into the dangerous state of the mind that is hard to bonus back from. The daily time frame setups up for the better success strategy straight away. You only spend a phrasing on of the time in front of the charts, so you are at least risk for exciting traders burners. It's going to be much easier to keep the cool head while maintain your mental and emotional disciplines. Another misconception is that the positions are dangerous to hold overnight. Now, the market are open 5 days a week. The Forex market is open 24 hours. It is fair to say that the holding positions over a weekend can be a little risky if your position is fresh due to the unexpected weekend gaps from high impact global events. But there is no belief to closing your trades at the end of the day. In fact, you could actually be shopping yourself in the foot by closing your trades too early. It's not uncommon for traders for trades to take 1 or 2 days before you see the breakout move from the setup. Have a look at the bullish rejections called captured on the daily time frame around the weekly point pivot point. The markets stayed for the few days before the shooting to the upside. This is the good example. This is the good example of why you need to be painted and let the market do what it needs to do. Chosen before the end of the day would have ensuring you were left straight behind regretting lost opportunities. I know it would be great if you could enter the trades and price produce to shoot of like a cannonball hitting your target strange away. This will occur sometimes, but you shouldn't be relying on happening too often. The reality is that some trades may dip into the negative territory once or twice before the maturing into profit. This dipping is out could span over the few days. You need to give your traders a chance and give the market the opportunity to do these things. Don't cut yourself short by closing your traders at the end of the day. The fifth misconceptions is that the price movements on the daily time frame are hard to project. This comes from the average west dispute of the technical as the fundamental analysis. They're the part of the traders who believe technical trading is only effective on the lower charts, and that having a good understanding of the fundamental analysis is needed for the daily time frame. You would need to be financial analysis to be able to find long-term movements. All data you need is displayed via the profitable that price leaves behind on your chart. The candlesticks technical analysis work extremely well on the daily chart, probably better than it does in most other time frames. The noise generated and the erection piece movements on the lower time frames will affect your technical analysis, hinder your ability to read the chart, and potentially rush you into many false signals. Thanks to the clarity the daily chart brings to your screen, the good trading opportunities are easier to be identified. So if your strategy isn't working on lower time frames, you are in the losing sticks and you feel that the market is ahead of you and goes against with every time you make the trade. Try the daily time frames. You don't have nothing to lose just by switching other to the daily time frame. You will make necessary corrections to be providing the way the better results. And remember, work smart, not hard. As always, if you've learned something new and found value, leave us a like and show us support. Subscribe to our channel and hit the bell icon to stay in touch when we will upload the next video. Until next time.